and welcome to Module 5. In this module, we're going to conclude the coverage of corporate taxation, and we're going to take a look at non-liquidating and liquidating distributions, as well as S corporations. And so we begin with calculation of corporate earnings and profit and the determination of tax consequences of non-liquidating distributions, the tax consequences of stock dividends, and various other tax treatments of stock transactions. And then we'll take a look at liquidating distributions, and this is going to begin with a discussion of the issues involved in corporate liquidations and the tax consequences of general liquidation rules. And the module concludes with an examination of S corporations, including the advantages and disadvantages of the S election, requirements of the S election corporation, revocation or termination, and then shareholder basis, and determination of taxability of an S corporation distribution. And so we start with Chapter 4, which goes over corporate non-liquidating distributions, and looks at the taxability of non-liquidating distributions. So if you're distributing earnings and profits, that is a dividend, okay? So basically what we're talking about here when we're saying non-liquidating distributions means that you're not liquidating the company, you're just giving a dividend. And then Chapter 6 covers liquidations. And so this is a situation where management decides to liquidate the entire corporation. In other words, they're not just returning earnings and profits to the owners, they're actually going out of business and shutting down. And then finally, Chapter 11 covers S corporations. This is an entity that is able to take advantage of the limited liability without having the double taxation of the dividends that are paid. Because when a corporation issues dividends, the corporation is paying income tax on those dividends, and then the shareholder that received the dividends, they are also going to pay tax on those dividends. So it's a double taxation. With an S corp, you're able to pass through the dividends to the shareholder without the double taxation. S corps don't really pay tax. It all flows through to the shareholders, and they're taxed only at the shareholder level. This is one of the reasons that S corps are so popular, especially for small businesses, because it does allow corporate losses to be offset by other shareholder income. So a lot of small businesses will opt for the S corporation. And so this week, we have week 5. We will not have a quiz this week. You do have a study plan to help you with your homework, and you have homework number 5 to complete in My Accounting Lab. Also, the discussion, don't forget about that. I can't believe we're already at week 5. This class is going by so quickly. So I hope everybody has a great afternoon, and I will see you in the discussion.